PR Connections Radio presents
Hi, welcome to the Real Deal Podcast. I am your host, Gavin Sunvik. I'm a local Las Vegas real estate and business opportunity broker. And so what is the deal? Well, today we're going to be talking about how to position your business for sale. This is incredibly important. Now, some people don't have a lot of time. They may only have a half a year or a year to position their business for sale. And that's still important that they take the correct steps when they're making that decision. All right. Let me just give you a brief example of what I'm talking about when it comes to selling a small business or a privately owned business. You see, a lot of people think their business is worth way more than it really is. But let's just say you own a business with 0 employees. Somehow you're able to generate about $500,000 in revenue. $300,000 of that is business expenses. Your salary is worth maybe about $100,000 if you were a manager at somebody else's business. And the actual profit at the end of the day is $100,000. It's not $200,000. So your business is less profitable than you really think because you have to pay yourself a salary, right? In most cases, when we're selling a business, we've got no automated systems, no employees doing the work for you. And in a highly competitive market, you might be able to sell a business just like what I described for about $200,000. Now, if the assets, meaning the equipment, the technology, all your operating stuff that stays around, if that's worth more than $200,000, your business is considered worth more dead than alive. That means we are doing what is called an asset sale, where we are literally just selling the machinery that runs your business and not the actual business itself. So when we have a business, though, that is worth $200,000 and they have less than $200,000 of assets, we are doing a sale of equity. And this is really important to understand. Under this example, you would have what I call a 2x multiplier, meaning your profit is about 100,000. Your business might be worth 200,000. That multiplier is 2x, meaning if you take on one new customer before you sell your business and the profit of that customer, is, let's just say $1, you increase your business valuation by $2. So it's really important that when we're positioning our business for sale, we understand what our multiplier is, because that'll help us understand how much we want to invest in acquiring new customers. Now, at the time of researching this episode, NVIDIA, which is one of the leading stocks right now in the S&P 500, is trading at a 50x earnings multiplier. Now, what does that mean? It essentially means that your business is not trading like the stock market is. And a lot of people might say, well, why isn't my business trading for a 50x multiplier? And we're going to get into that in the rest of this episode. A couple of the problems I want to go over that most business owners are going to have to solve before we get into some of the details are tax reduction strategies. You see, nobody wants to overpay on taxes, but at the same time, there are some tax reduction strategies that show that a business has not matured into a thriving organization. NVIDIA, for example, is a thriving business with an established marketplace, with established competitors and processes and systems and employees that are in place, right? They don't worry about, paying $2,000 in taxes, 1 year versus the next, right? They pay what they owe, and that's about it. There are certain tax reduction strategies that, if taken to the extreme, make your business look less profitable than it really is. And at some point in time, your business just has to pay the taxes that it honestly owes in order for it to get the valuation that it needs. Next problem that we're going to dive into a little bit later on in this episode is marketing systems and assets, right? And what I mean by that is like your marketing assets are things that you've paid for, like graphic design, whenever you have video edited into an advertisement. All of these things need to be kept, even if they are considered old advertising. Word of mouth marketing is great for your profitability, but if you have no systems to track customer data, follow up with customers and keep them coming back, and exposure to reach new markets, your business is surviving and not scalable. Buyers want a business that is scalable. They want to make great profitability off their purchase, not mediocre profitability. The third problem is selling a job, not an organization. What I described earlier in this episode as an example of a business that might have a 2x multiplier, you're kind of selling a job to a certain degree. And think of it this way. Realistically, yes, your business is profiting $200,000, but you have to pay yourself a salary. So your business is really only earning 1x what you're taking home as the owner, right? Really, if you have a 1x multiplier, that's a job, not a business. So there are plenty of solopreneurs who successfully sell their business due to the demand of their service and access to niche customers. So I'm not saying that if you own a business and you are a solopreneur, that you can't sell your business. It just does not always lead to high valuations. Next thing to consider is reinvesting too many profits back into the business. Nobody wants a business that looks like it needs a lot of investment to continue to operate. And what I mean by that is if you're constantly investing into your business in order to keep it growing, but your revenue is not growing drastically faster than your expenses are, then it looks like your business is very needy. It doesn't necessarily look the most sustainable, even if your business is healthy and is profitable. So what we have to do is we have to make sure that we're reinvesting the appropriate amount to have healthy business growth, but not too much to the point to where it looks like we're unprofitable. Goes back to those tax strategies, right? Plenty of people overinvest back into their business to see it grow more next year to avoid paying profits this year, but it does not mean that it yields the best valuation for your business when positioning for a sale. All right, we're going to go over the fifth mistake, and that is not positioning your business as a good deal. You see, no one wants to buy Radio Shack at its peak, right? Today, you can't even find a store location that's open, and your business needs to be something that people think still has some meat on the bone, right? Think of businesses like Netflix, right? 10, 15, 20 years ago, if you had invested in companies like these, you would have made a fortune, right? And that's what buyers are looking for. They're looking for that little seed that's going to grow into an amazing tree one day. So don't position your business as something that looks like all of the value has already been sucked out of it. All right, before we get into some of our findings and solutions, getting into some of the meat and potatoes of preparing your business for sale, I want to go over a segment of our podcast called the Conservation Corner. So where we just briefly update you about some of the things that are going on in the state of Nevada regarding wildlife. And September 13th, Wildlife Habitat Improvement Nevada, which I sit on their board of, helped a bighorn sheep water resources build in the deserts of Tonopah, Nevada. Joined with us were the Lusk family, whom the build was named after, Bighorns, Nevada Bighorns Unlimited, and the Fraternity of the Desert Bighorn all helped the Nevada Department of Wildlife create some bighorn sheep habitat so they can survive the harsh environments that they call home in our Nevada deserts. These water resources help the bighorn sheep evade mountain lions so populations don't become unbalanced. So incredibly important work. If you want to see some of the stuff that I do in wildlife conservation, you can follow us at Ethics Realty on Facebook or Instagram. All right. Let's jump back into business valuations and making sure that your business is positioned as great as possible for sale. Again, consider that these are all strategies, and some of these strategies take more time to work. The more time you have, the better you can increase your current business's position from where it is today to when you actually end up selling it. But the less time you have, it's going to dictate that you need to do more conservative strategies. All right, tax reduction findings. There is no benefit in paying extra in taxes. Always write off what is rightfully owed to your business. Essentially, what that means is don't cook the books, right? Don't ever choose to pay more in taxes in order to make your business look more profitable. But at the same time, you should not skim cash payments, overpay for expenses. For example, I ran into an example when I was in school. There was a business owner who was prepaying a bunch of his next year's business expenses in December. So that way he didn't have to write off as many, he didn't have to pay as many taxes come January. And what that would do is make his business look less profitable on an annual basis. Eventually, this catches up to you. Eventually, you run out of expenses that you can prepay. And generally speaking, on any money that you skim in taxes, if you're saving maybe 25% is your annual tax rate, and you have a 2x, business profitability multiplier, that means it would take on average 8 years to break even from wrongly reporting taxes, let alone the consequences if you get caught. So any tax advisor that's advising you to do anything that seems shady is probably doing something that could actually end up hurting your business valuation. Actions. So do actually write off personal expenses that are not necessary for your business, but you do enjoy being a perk as an owner. For example, your vehicle. Your vehicle as a business owner is something that you use to operate your business. And it's something that you should write off on your business. And anybody purchasing your business has the capacity to understand why you would write your vehicle off as a personal expense, even though you're writing it off as a business expense on your taxes. Equipment, TV or streaming services can all be recast into your valuation. So you can run your Netflix subscription, your TV bill, and things like that that you like to enjoy through your business if you want to, as long as it is available in your office, for example, for employees to enjoy on their lunch break or what have you. The buyers are going to wonder, though, if you write off too many networking dinners. They're going to also worry about if you're taking massive amounts of things that are like vacations that you're writing off as business planning meetings. Things like this do trip buyers to thinking that you are really working a job in your business and you're not really truly a passive business owner if you need to do all of these unnecessary meetings. So consider this when positioning your business for sale. Possibly within the last 3 to 5 years of owning your business, you should really reduce the amount of unnecessary write-offs that you have within your business. All right. Next thing that we're going to be going into is marketing systems and assets. We talked about if your business relies on word of mouth marketing, this is actually a good thing because word of mouth marketing is way less expensive than other forms of marketing and can produce higher returns on investment. The problem, though, is people are incredibly unpredictable. And so you have to have a more robust system that is more predictable at introducing your business to other people that are likely to see your advertising and actually do business with you within a short period of time. It's a really complicated way to saying you have to have some marketing systems that you can sell to your next buyer and say, hey, look, if you want to grow the business even more, this is our return on investment. So if you want to put some extra money towards this, you're probably going to increase the capacity of this business, or you're actually going to operate the business at a higher capacity or closer to its true potential. If you're absolutely stuck on where to invest your marketing systems, first invest in data collection systems. These are also known as customer relationship management softwares. And the reason why this is so important is keeping customers in your business is way less expensive than trying to market to new markets. If you can't continue to reinvest and to communicate with your current contacts and your current clients and your current customers, there's no point in spending the extra money that it takes to get a new one. After this, what we're going to be working on is advertising, any kind of artwork that you're doing, anything that you're paying for, when it comes to creating some kind of a graphic art or a video, save all of this and document all of this. A great example of a company that has mastered this was Old Spice. Old Spice actually took all of their old advertisements and created a YouTube channel. So not only are they getting free advertising on YouTube, but they're also getting ad revenue from YouTube as a resource. And why did this work? Because their ads were funny, right? And people would actually show their kids, hey, look, these were like the funny ads like we used to see when we were kids or when we were younger, right? And so it's literally free word of mouth marketing for them in order to employ this strategy. Now, you might not be the next Old Spice. However, you need to consider that anytime you pay for marketing assets, you may have another use for them in the future. And so make sure that those are documented, because those are things that buyers are looking for. Okay, the next thing is turning your job into an organization, right? Having a general manager to oversee and run day-to-day operations while planning for long-term success should not be your first hire. Everybody obviously wants to fire themselves first, but it's way easier to fire yourself from smaller jobs first and then work your way up to more complex positions as your skills and ability adapts along the way. Because here's the thing, most entrepreneurs get burned by their first hire because people are unreliable as a whole. Doesn't mean that you will not find reliable individuals to work for your business eventually. With persistence, you will, of course, find competent and reliable employees. However, your first hire should probably not be one of the most important positions in your company, which is a general manager. You should be doing that job at first. So what makes your company worth buying is when you have found the right people who are abnormally reliable, right? After you have been burned and you've consistently overcome that challenge of vetting people who aren't going to do the job well and finding people who are. Your job as an entrepreneur is to understand everyone's role and fire yourself incrementally, one step at a time, each time increasing the amount that you make per hour. So what that means is the first thing that you have to do is you got to fire yourself from $8 an hour level tasks. If you are still doing those, you have no business hiring a general manager making $60 an hour or $30 an hour even. So consider starting with the really little things in your business first. Before you start succession planning, there are resources available to help you grow your leadership skills, to hire a better team. Honestly, while I have led a team, I am still working on my leadership skills within my company. That is the thing that I am working on right now. So I'm not going to give you necessarily leadership advice on how to get to the next level after what I am on. Well, what I'm saying is there are organizations out there that can help you with leadership, and I would invest with those people to help you lead your team. All right, let's go into the fourth problem, and then we're going to help you find some solutions on what to do with this one, because in my opinion, this is where your business broker can help you the most if they really understand finance, is reinvesting too many profits back into the business. So we talked about one tax reduction strategy that actually makes people feel productive is to continue to invest profits back into their business. This can actually be a winning strategy for companies that want to go public, but it can often be counterproductive for fetching the largest valuation for a private buyer unless you intend to do an asset sale. And so that's an incredibly complicated statement that I had in my notes here, so I'm going to break it down for you. If you are a business that relies on vehicles, for example, it can drastically improve your valuation by constantly buying vehicles and then hiring people to operate them in whatever service you do. Let's say you do pest control, for example, and you need a truck that is loaded out with equipment to do pest control, and you need an employee to go run that piece of equipment. That might be the bottleneck in your organization. So you might be reinvesting profits into buying more trucks so you can hire more employees, so you can take on more customers. This is obviously a fantastic way to build your business. However, just remember that those vehicles asset value are going down in value. So if it's not leading to net bottom line profit by the end of the year, you're probably trying to grow your business too fast. And of course, it's always great to see, hey, I started just me with one truck. And then, I ended up with 2 trucks, and then I ended up with 5, and then I ended up with 15. And you see this exponential growth as something that's really positive. But if it's not making bottom line more profit every single year, you might be trying to grow too quickly. And so another thing to consider is investing in real estate. And the reason for that is it would help you justify growing that profit margin even more. And I'll tell you why. Remember what I talked about earlier? If you take on a customer when your business is at a 2x multiplier, you essentially make $1 in profit, but your business valuation goes up by $2. Well, in real estate, it's more like 10x. If you have a tenant and they make an extra dollar, right? That means you can charge them an extra little bit in rent every single month. And they would still be profitable and still be willing to rent that space from you. And every dollar you increase your rent by per year, you increase the property value by 10x. And so it might be a lot more efficient for you to build your wealth by buying some real estate. And instead of buying a lot of trucks, you buy a few trucks every single year, but you massively increase profitability every single year and therefore leftover cash. Instead of that leftover cash just being turned into something that's going down in value, now you have a 2x multiplier in your business plus a 10x multiplier in your real estate. You can possibly turn each dollar in profit into $12. That's making money with money. Making money with feeling good does not necessarily yield the best buyer sentiment. So consider that if you're going to reinvest your profits, the first thing I'd probably do is own the real estate that your business operates in. After that, there's some other options as well. As a matter of fact, our podcast is sponsored by both Robinhood and Webull. Robinhood, in the link in the description below, will give you 1 free stock just for signing up and depositing some money. Robinhood, in my opinion, is perfect for brand new investors because the platform is super intuitive and easy to use and not very complex. Now, Webull, in my opinion, is when you're kind of ready for that next level. Webull's like the social media of trading. And the more you deposit, the more free stocks they'll give you if you use the link below. So if you're wanting to deposit maybe $10,000 or more into an account, I'd probably go with Webull. What I like about Webull is the social media aspect of it. You can go onto a stock that you're interested in purchasing, click on feeds, and you will see investors' commentary on those stocks. Now, most of it, like most social media, is useless, but once in a while you find some nuggets of information in there that could give you some key data on whether or not you're going to make that decision. So always make your purchases based on your own research, not mine. But if you're going to trade, feel free to use the links in the description below, and you get to support the channel while you do so. All right, the last problem that we're going to help you overcome when positioning your business for sale is not positioning the business as a good deal. So essentially, remember, we created this example in the beginning of the episode, right? This person's making $500,000 a year in revenue, and yet they're going to sell this business for only $200,000. That seems like a bad deal for the owner. But think of it this way. If I'm the buyer, right, I want to turn my $200,000 into a reliable cash flow machine that I can reinvest and grow. And I need something that's going to be worth taking on this risk, right? Because I could probably just put that same $200,000, I could buy NVIDIA stock. And I'm not saying that NVIDIA stock's going to go up, 30% next year, but most likely I can check my bank account next year and it'll be $250,000 or more. And I didn't have to lift a finger, right? I didn't have to do anything in order to make that money, right? So if I'm investing in your business and I have to do day-to-day operations, I have to take on the risk of some of your customers really liked you as a person and they didn't care about your business. And so they're no longer going to do business with me, right? Just because I purchased your business. So I have to deal with that reduction in business. I have to have at least the opportunity to make 100% on my money. But at minimum, I want to be making at least 50% on my money. If I have $200,000 invest into your business in a year, I still have a $200,000 business and an extra $100,000 in my pocket. Now I'm at $300,000 worth of wealth, right? That to me, in my opinion, will kind of overcome some of those risks. And so I'm not the only person who thinks that way, right? There are other buyers who make that same risk analysis on where they can put their money and where they can put their time. And that's how they're making their decisions when purchasing a business. If they can make at minimum 50%, it's probably worth at least investigating. So make sure that your business has the ability to make at least a 50% return when positioning it for sale. I always bring owners the conversation of seller financing as an option for the buyer to take over their business. Now, you have to be careful with seller financing. Always consult with your business broker because they'll understand the risks in your business on what to do and what not to do when offering seller financing. But just as a blanket statement, you can drastically increase the price that you can sell your business for without having to dip into the buyer's returns. And so essentially the buyer makes a higher return on investment. You get more money in total for selling your business. So it does kind of end up being a win-win if you know how to position it correctly. We can talk about that most likely in a later episode. Do want to talk about episodes that are up and coming. The next episode is going to be how to prepare for a recession. I know it's a scary R word nobody wants to hear, but October is right around the corner. And within the spooky season, what more perfect of a topic than to talk about preparing for recessions? I appreciate you guys for watching. Make sure you tune in to the next episode of the Real Deal Podcast.
PR Connections Radio thanks you for watching this podcast. Check out more episodes of this show and our others at prconnectionsradio.com.